Futures and option trading. Future trading. Future trading is a financial transaction that involves the buying or selling of a financial asset or commodity at a predetermined price, with the transaction taking place at a future date. Future trading is typically used as a way to manage risk or speculate on price movements in various markets, including commodities, currencies, and financial instruments like stocks and bonds. In a futures contract, two parties agree to buy or sell an underlying asset at a specific price and at a future date. The buyer of a futures contract is obligated to buy the underlying asset at the agreed upon price, while the seller is obligated to deliver the underlying asset at that price. The price of the futures contract is determined by the market demand for the underlying asset, and it can fluctuate until the contract is settled. Future trading is typically conducted on exchanges, where traders can buy and sell futures contracts for a wide range of assets. These exchanges often have strict regulations in place to ensure fair trading practices and to prevent manipulation of prices. Overall, futures trading can be a useful tool for investors and traders who want to manage risk or profit from price movements in various markets. However, it can also be risky and complex, and traders should carefully consider their goals and strategies before getting involved in this type of trading. Importance of future trading. Hedging. Futures contracts allow businesses and investors to manage risk by locking in a price for an asset or commodity, providing protection against potential losses due to price fluctuations. Price discovery. The futures market provides valuable price information that helps businesses and investors make informed decisions about buying and selling assets or commodities. Liquidity. Futures markets are highly liquid, meaning that there are always buyers and sellers willing to trade. This makes it easier for investors to enter and exit positions quickly, and for businesses to buy and sell commodities with ease. Speculation. Futures trading also provides opportunities for traders to speculate on price movements, which can help to increase market efficiency and liquidity. Arbitrage. Futures trading can also help to create opportunities for arbitrage, which is the practice of buying an asset in one market and selling it in another to take advantage of price differences. Option trading is a type of financial trading that involves the buying and selling of options contracts, which give the holder the right, but not the obligation, to buy or sell an underlying asset at a specific price and time. Options can be used to speculate on the direction of price movements in various markets, as well as to manage risk and generate income. There are two main types of options: calls and puts. A call option gives the holder the right to buy an underlying asset at a specific price, the strike price, on or before a specific date, while a put option gives the holder the right to sell an underlying asset at a specific price on or before a specific date. Option trading can be complex, and there are many different strategies that traders can use to profit from price movements. Some of the most popular strategies include buying calls or puts, selling covered calls, and selling naked puts. One of the key advantages of option trading is that it can allow traders to profit from price movements without having to buy or sell the underlying asset. This can be especially useful for traders who want to gain exposure to markets that may be difficult to access or too expensive to trade directly. Flexibility. Options offer investors the flexibility to customize their trading strategies according to their risk tolerance and investment objectives. This flexibility allows investors to choose the right options that suit their investment goals. Hedging. Options trading can be used as a hedging tool to protect against losses in a stock position. Investors can use options to create protective puts or covered calls, which can reduce risk and limit potential losses. Potential for higher returns. Options trading can provide investors with the potential for higher returns than traditional investments. This is because options provide leverage, which allows investors to control a large amount of stock with a smaller amount of capital. Diversification. Options trading can be used as a way to diversify a portfolio. Options can be used to invest in a range of underlying assets, including stocks, bonds, and commodities. Income generation. Options trading can be used to generate income through covered calls, where an investor sells a call option against a stock they own, collecting the premium and potentially profiting if the stock remains below the strike price.